So, welcome. Today we are going to discuss hurdle rate and catch up clause. So, what are these terms in venture capital? So, hurdle rate is nothing but a minimum return which the general partner has to generate before taking any carry. So, 8% is the general hurdle rate in venture capital. So, he has to generate, let's say he has turned 100 rupees into 250 rupees. In the earlier example we discussed that 100 rupees was turned into 1000 rupees in 10 years time, but let's say in the initial 3 years he turned 100 into 250. So in that we'll discuss how the hurdle rate works. Before moving forward, there is a disclaimer that my knowledge is limited and the information which I share is based on my current understanding and learning. So I can be wrong at times, and I welcome open discussions and corrections in the comments below. So let's discuss. 100 was turned into 250. First of all, the hurdle rate is 8%. So every year 8%. So 10 years combined it will become 80 crores. I am taking it as a simple interest. Actually it is compound interest, but it becomes easy to understand. So every year 8 crore will be the hurdle rate. So for total 10 years it will be 80. So till 180, that is 100 is the capital and then the 80 crores is the hurdle rate. So till 180 the general partner is not entitled to a single rupee. Whole 180 will go towards the LP. So GP will not take anything in that. Then after this there is a catch up clause. So what this catch up clause says is 250 minus the 100 capital. So 150 was the profits made by general partner. So usually he takes 20% as a carry, so which is 30. So after 180 has been given to the limited partners, the next 30 will straight go to the GP, and then the remaining 40, that is 180 plus this 30 is 210. So 250 minus 210, which is 40. So out of 250 now 40 is left. So that 40 will then be distributed into 20 and 80%. So 20% will be taken by the general partner and 80% will be taken by the limited partners. So to sum up, 100 was turned into 250, 80 was the hurdle rate. So 180, which was the hurdle rate, so if you subtract 250 minus 180, so leftover is 70. Then after 180, 30 is gone to GP, so 210. Then 40 is left over, so that will be divided. So I hope it's clear. And this whole thing of distribution of profits, this is called as waterfall in venture capital. So there are two types of waterfall. One is American waterfall and other one is European waterfall. So basically American waterfall says is you distribute the profits deal by deal basis. So let's say we invested in 50 startups. So as in when we sell some of the startups, let's say we sold 5 startups. So on every deal by deal basis you distribute the profits. In European waterfall says that let the entire fund life cycle get over. After 10 years we will distribute everything at once. Everything will be distributed according to the waterfall structure of like hurdle rate, then the catch up clause, then the remaining will be divided in 80-20 on a total fund level. That is all the 50 companies I have been sold, and now the entire return is calculated, that is IRR, and then it is distributed. So that is European waterfall. American waterfall is deal by deal basis. So some deals might not do well, some deals might do well, so GP can take an advantage in that. And European waterfall actually favors limited partners. I will discuss this maybe in one separate video, but this is what it's generally used. That is, these terms are used like this in venture capital. So let's understand it in a diagrammatic way. So 8% was the preference, that is hurdle rate, which can be also called as preferential rate of interest, because it is the preference is given to the limited partners. That's why it is also called as pref. So first 8% will go to them, then 2%, let's say, is the catch up for general partner. Why it is called catch up? Because he is catching up with the profits, which the first initial 8%, 100% went to the LPs. So after that he catch up the profits, the 20% of the total amount, and then the remaining whatever they make from this 10 to 20% range, everything gets split into 80 and 20. So first 0 to 8% preference hurdle rate, then 2%, let's say in between here somewhere is the catch up, which is taken by the general partner, and then above this is split in 80-20. And before even starting the fund was started at 100. So every year 2% of that is charged as a management fee, which is charged to pay the salaries of the general partner and the team below him. So management fee is different from this. So it is charged 2% every year. So the general partner in totality he has to return the 100 rupees, the capital which invested by the LPs, then the 80 rupees hurdle rate, 8% every year, then also sum up the 20 rupees of management fee, that is 2% every year, so 10 years 20 rupees, and then over and above all of this, then he starts making money. So the incentives are aligned in such a way that when the LPs make money, then only the general partner will make money. So that's how a waterfall structure is structured.